want to talk more about the markets and bring in our next guest. He's here to discuss the venture capital environment, AI, the IPO market, and so much more, including your ideas about investing in America, which I want to talk about. Brad Gerstner is here. He's the founder and CEO of Altimeter Capital, a private tech investment firm. He's made investments in Snowflake, ByteDance, Okta, Epic Games, Orbitz, and so many others. So where are we, sir?
Good to be here.
It's nice to see you. But what do you think is really happening with this market? Where do you think interest rates are going? What's the risk on, risk off situation?
You know, we've been through a pretty epic journey over the last 3 years. I think I said about 18 months ago that the new normal is going to look a lot more like the old normal, faster than we think. But we have to get through this process of adjustment.
What is the old normal?
So if you think about the period of time for 2010 through 2020, we were roughly at 2.8 on the 10-year. I think we're going back to a period of 3 to 4 on the 10-year, a highly investable period. What people can't deal with is the volatility, right? Just think about this. In the last 6 or 7 weeks, since July, we have a 25% move in the 10-year, right? And so the NASDAQ is down 12% during this period of time. And then, of course, we've had this run over the course of the last 8 days. That's the process of normalization, as people try to get their arms around where is the 10-year going to settle out. I look at inflation. The PCE over the course of the last 4 months is annualizing at something like 2.5%, 2.6%. We think by summer of next year, you'll have a 2 handle on inflation. You know, nobody wants to acknowledge that there's an envelope here for a soft landing. And we have our issues. We have our issues. We certainly are slowing down the economy. But I think the mispositioning this year, if you will, is that everybody was prepped for a hard landing. Mike Wilson had scared everybody at the start of the year, so everybody was in crash position. And the reality is the market has performed quite well this year, despite a regional banking crisis, despite conflicts in Ukraine and Israel, despite all of these other challenges.
So you're bullish?
I would say that we've been constructive and optimist all year. Our net exposures, we started the year very bullish relative to where prices were in the market. We were priced for a hard landing. So we were 93% net long, Andrew.
But you think you're through the worst of it?
Well, the question on the table now is, does the Fed overbake the cake, right? May of 2000, let me take you back.
Well, what was the 10-year in May of 2000? That's what I'd see. For me, 3 to 4 is still
a no-brainer.
But it's still a new normal. We used to be 5 or 6.
Oh, yes. Why
don't we go back to
I'm saying that because we don't need to. I mean, the fact of the matter is that so long as we have full employment and so long as we have stable inflation at or near the target, we're going to be in this lower range. But the fact of the matter is, Joe, as you remember, we did great between 2001 and 2007 with a much higher rate environment. But what we need is we need predictability. Yeah. And what we haven't had the last 3 years is predictability. And, you know, listen, we beat a pandemic. In March of 2000, when I came, or 2020, when I came on, we didn't know if this was Ebola. Yeah. Right? And so the Fed went all in, Congress went all in. That was the right thing to do. But by the summer of 21, when the Fed was saying they don't see inflation, that was clearly a mistake. The cost of a cargo container from China had gone up 10x. So we waited 6 months too long, and the consequence of that is we had to go a lot higher. But if you look at the Fed's own forecasts for next year, 1.5% GDP, 2 to 3 rate cuts, ending the year with a two handle on inflation. To me, the thing that people have been most mispositioned for is that the world may, in fact, go back to, to this normal. For us, our net exposure today is 60%. Like I said, we started the year at 93. So, yeah, we've taken some risk off the table as prices have gone up, but we're still leaning forward and still bullish on America.
What do you like? We spend a lot of time talking about AI right now. Is that where the opportunity lies? Where is it?
So, when we entered the year, one of the things we said is not all tech is created equal. Remember, tech went through a recession in 2022, right, a year ago. Everybody crowded into the same trades, the safety trades of bonds, the safety trades of cyclicals, et cetera. We've seen a reversion to the mean. Think about this. The SPY, say S&P is up 15% this year.
Right.
If you take tech out, it's down 2%. Right. Okay? The Russell 2000 is down this year. I think that's a healthy correction from where we were last year, where X tech was overvalued as a safety trade. Tech, the best parts of tech have moved up. If you're a COVID pretender, you haven't gone up this year. I see some names floating across the screen this morning.
Who's a COVID pretender in your mind?
Well, I see a name this morning like Upstart as an example. Nothing against the company, provide car loans, and car financing to folks, but they pulled forward massive demand during COVID, and now the give back comes. But if you look at a company like Uber, who you did a great interview with Dara yesterday, or a company like Meta, they've seen expanding margins this year and reacceleration on the top line. I wrote a letter last year about time to get fit.
Right.
You know, Andrew, Mark Zuckerberg in March wrote the year of efficiency. And Dara told you yesterday, quarter over quarter, we've actually reduced headcount again.
Right.
We have this massive bottom line opportunity in all these businesses because of AI. Margins are expanding.
I'm just looking. Robinhood is running across the screen a lot, too. Is that a pretender company because there were so many people who were home betting on the markets who aren't now?
Pretender may be a little harsh.
That's your word.
Yeah, you're right. What I mean by that is we pulled forward all this demand that was not sustainable in a world. I mean, I look out the window here. People are back to work. Right. They have to take Ubers to get back to work. They're not sitting in their homes doing the things they were doing during COVID. And one of those things was day trading meme stocks, right? And so that was just the give back. But it's incumbent upon those companies to adjust. It's hard to adjust. Nobody on this set wanted a pandemic in March of 2020, but that's the hand we were dealt.